Welcome to the show today, and we're going to continue to talk about retailers. And we spoke with Go Colors yesterday. Today, we're going to be speaking to the management of V2 Retail. They're on an aggressive growth clip, and the clip is far more aggressive than when they had guided for in FY26, and the execution is also much stronger. But there are a couple of weaknesses in the numbers, at least for Q1 FY27. We'll try and contextualize that. Some of it is also seasonality playing out, but essentially, in terms of valuations, this one is trading at a 3-year low in terms of price to earnings. And the outlook, at least for FY27, is looking extremely robust. Let's first start off by giving you a perspective of what the company is all about. Well, it's in the retail space and in the value fashion space, especially in retail. It manufactures affordable apparel for tier 2, tier 3 and beyond. Really, that's the target cohort. It was incorporated in 2001, a very fascinating history, by the way. Basically, the Agarwal family, or the founder, Ramchandra Agarwal, he actually incorporated Vishal Retail. Due to debt, he had to sell off the business and reboot and restart this same company as V2 Retail. And thereafter, he's built an 8,000 crore market cap company out of that. So it's his second stint. And the learnings from that are that they don't take debt in a large fashion with regard to driving growth. So essentially, they keep raising equity rather than taking debt. They prefer the more conservative approach. And despite that, they're doing 50% growth on the top line, guided FY27. They've done that even in the past, and therefore they've demonstrated a strong ability to grow, and hence makes it a very interesting proposition. In terms of the story itself, let's pull that story out. And essentially, it sells affordable clothing in smaller Indian towns. The major growth engine is the rapid new store openings, which are playing out, and they're going to do 170 to 200 store openings on a base of 400, at least at this 381 odd at this point in time. They've just about crossed the 400 store milestone in August of 2026. Essentially, it's about driving their own stores and private labels within the stores. There's in-house manufacturing also, which to some extent they're going to start outsourcing and essentially focus on the retail side of things. And the real test is whether the new stores which they put out are going to stay productive or not. I've put out some productivity metrics as well later on in the deck. Let's now look at some of the products. And you'll see there are products across the board: menswear, women's wear, kids wear. They're also into not just these three. They also do lifestyle products, sunglasses and the like. In fact, let me quickly take you through that product list of theirs. And within pretty much apparel, there's shirts, trousers, denim, sportswear, winter wear. On the women's side, there's kurtis, ethnic sets, tops, occasion wear, winter wear. So quite a broad range. For kids wear, there's boys, girls, infants, school, as well as winter clothing. Lifestyle products is footwear, wallets, sunglasses, purses, deodorants. There's private label brands which they're building in-house: Godspeed, Herlich, Glamora, Ebelia, and Honey Brats. All of those are being built internally. Those are brands housed within V2 Retail. And they have a manufacturing subsidiary which essentially takes care of the manufacturing part of things. 70% gross margin broadly is what they make. In terms of the business model, they source fabrics and garments from vendors and they process that in their own unit. The designs are made in-house and to somehow protect gross margin to a certain extent. They sell through company-run stores nationwide. In terms of the number of stores, they've got around 381 stores at this point of time, or rather Q1 FY27, now at around 400. They're present in 25 states, 300 plus cities. 381 stores and 300 plus cities is the kind of spread that they have. State-wise, the mix will come up on your screen. The largest states are UP and Bihar, which account for 30%, which will come up on your screen. UP, Bihar is 30, by the way. Thereafter, you've got Odisha at around 9, and then Madhya Pradesh and Assam at 7 each. That takes the count to 54%. And then balance is the others, which is 46%, which is the larger chart you see. There are 20 states in that chart broadly. When you're looking at the store level mechanics, this will give you a perspective of how to look at each store. The break even is around 500 rupees as quoted by the company. But I have calculated around 500 to 550. We'll get the exact breakup there. 70% is raw material costs. out of this. So a predominant part, let's say 350 rupees, 350 to 370 is raw material costs alone. Thereafter, you've got 50 rupees per square foot per month being the cost of rental. This is all on a per square foot basis. So we're not even doing it on a store count basis, on a per square foot basis, per month basis. And 140 is the per square foot per month of other variable costs, which is personnel, billing, and the like, right? Everything else, overheads, sit in that. So around 190 is the variable cost there, outside of the raw material cost. So that's how you get to around 500, 550 in terms of the break-even cost. And this is even on the newest of new stores, right? Let's talk about the financials now. Take you through the numbers. You've seen a very strong 54% growth CAGR last 3 years. So you've seen the business really take off. You've seen EBITDA grow at 81%. Margins get better. Efficiency gets better as the store count widens. Some of the fixed costs, which is design-led costs or manufacturing-led costs, get apportioned because you have to just build the same kind of unit that much more times, right? So that doesn't really make much of a impact on the variable side. It's more of a fixed cost, and therefore you're seeing margin tailwind also play out. Net profit, which was negative, which was loss-making at one point of time, has now turned sharply profitable. We're at 160 crore of net profit, and you've seen a very sharp growth. If you see the last couple of years, we've not calculated the CAGR because obviously the base is super low and makes no sense. Let's talk about margins now. And in terms of the margin clip, you'll see a steady uptick in terms of margins. Q1 FY27 was at around 14%. We've seen 13 to 15% in terms of margins, even though management guides, even the mature stores do 11 to 12%. So we'll try and get some color as to where margins start settling in at as this growth continues. The store count, and this is where a large part of the growth comes from, right? You look at, and after this, I'll take you to the top line again. If we can rewind to the revenue number just after this, I'll give you a perspective of how to look at this. FY24, 117 stores, FY25, 189, FY26, 325, and Q1 FY27, 381. So what we've seen is a non-linear increase just in terms of number of stores, right? So you've seen rapid expansion take place on a very low base. So just the number of stores itself adds to the top line, right? So this 54% kind of top line growth. SSSG, which is same store sales growth, is one part of the function, which is the existing stores. How are they growing? The mature ones, 2, 3, 4-year-old. And the other one is the new stores, which are giving the kicker to the revenue. So here currently, why is the growth 54%? Because you've got the new stores giving the kicker at this point in time. And as the new stores continue to grow at 40-50%, you will continue to see this kicker. Once they start tapering, you'll likely start to see the growth also taper. So till you've got new stores growing, and we will pose this question as to how quickly can they continue to grow. Now, in terms of the balance sheet, you've got 900 crore of book value on an 8100 crore rupee market cap, 8,000 crores, so around 9 times book is what this one trades at. You've got a borrowing number of around 250 odd crore. Which management has said has scope to go up. And then you've got a cash bank balance as well. You look at cash flow, well, this is where the challenge lies. As you continue to scale the business at a far faster clip, cash flow is negative, and that's because it requires inventory. So every new store requires around 1.5 crore rupees of inventory. And that is what is getting occupied in the working capital requirements, due to which you're seeing your operating cash flow being negative. That's how you kind of look at it or read through it. Return ratios, you'll see return ratios have started to pick up. 17 to 20% is where the ROCE numbers now currently stand. The ROE numbers have been healthy, 20+%. Let's talk about shareholding. Shareholding pattern currently 51%. Promoter holding, FIs hold 3, DIs hold 11, and the public holds approximately 35%. DI holding was 0 not too long ago. So DIs have really picked up in terms of the stake. Let's talk about valuations very quickly. 48 times earnings is what this one trades at. Trailing 12 months is all trailing 12 months. A 3-year average is around 90 times, and the 3-year range is between 47 and 160. So trades at the lower end of the range. One more thing I want to quickly flag off. 50% revenue growth will mean 4,600 crore of top line. At an EBITDA margin of say 13%, that takes you to EBITDA of 600 crore. and to a PAT of around 220 odd crore, which says that the 1 year forward, which is the FY27 price to earnings multiple, will be 36 times. On that, if I do a 25% growth, all other assumptions being the same, the profit will be 330 crore as operating efficiency kicks in, and you'll see the price to earnings compressed to 24 times FY28. So that's probably giving you a bit of a picture. 50% growth FY27, 25% growth FY28, and 25% growth FY29 is what I've penciled in, with no margin getting better. Margins remaining as is at 13%. That's how we're stacked up. We'll slip into a very short break, come back, speak with Akash Agarwal, who's whole-time director at V2 Retail. He'll join us, give us his perspective of how to see the business maybe next 2 to 3 years. Akash, I'll come straight to you. Welcome back. We're in conversation with the management of V2 Retail. We've tried to dissect the company the best we can, and Akash Agarwal joining us now to give us a perspective as to how he sees the business going forward. Akash, 7.5% SSSG is what you've done in Q1 FY27. Street wasn't exactly enthused about that. You believe that October, November is really the time when SSSG kicker will come in, because you've not changed your full year guidance of 8 to 10%. And can you do the higher end of that guidance? Are you confident of that? I'm trying to get a sense.
Yeah, hi, good afternoon. So in the first quarter, there was a 30-day period of Adhik Mas. So that had negatively impacted sales because there were no wedding dates. And wedding is a huge season, especially in tier 2, tier 3 towns, because most of the weddings are summer weddings in the smaller towns. So that is why we are, positive about the future outlook, because all the festivals are in quarter 3 this year. But there will be a slight impact because of the price hikes, because the raw material prices have gone up, and the price hikes will, I think, come into place by September, October. So it might negatively impact volumes, but we're still confident to do 8 to 10% SSSG over the whole year.
Okay. How much of a negative impact will it have on volumes? Because my understanding is your hikes will not be more than 5%, right? Will that also have a material adverse impact on volumes? How much? You've done nearly 50%, 47 odd, quite regularly. What will the impact be therefore?
So it's not just the impact because of our price hikes. It's an impact because of the overall inflationary pressures across the customers' spending categories. So if they have less disposable income, that might have a direct impact on their consumption. So it all depends on how much the commodities prices increase, how much the diesel petrol prices increase. But if it's just 4 to 5%, then I think there would be insignificant impact on our sales.
Okay, just 4 to 5% insignificant impact. And your gross margin, how much of a knock does that take if you just do 4 to 5% in terms of price hikes? How much are you anticipating in terms of the price hike?
So we are looking to maintain our gross margins. In fact, because of economies of scale and because of our volume increase, we have got at least a benefit of 3 to 4% in our sourcing cost, especially for fabrics. So we are passing that on completely to the consumer. So that's why we are only going to take a price hike of about 4 to 5%.
Okay, so 4 to 5% insignificant impact on volume. And how much have RM prices climbed by? How much should your typical hike be, which you're not really taking right now? Because my sense is eventually you will pass that through, right?
No, but that completely depends on whether this raw material price hike is temporary or permanent. So the raw material prices have gone up almost 7 to 8% on an average portfolio basis. And we've only had to take a price hike of 4 to 5% because we got a benefit of larger consolidating our vendors and larger volumes.
Now, Akash, I want to take a bit of a step back, because your entire growth lever, the larger growth lever rather, let me change my words. The larger growth lever is going to be the number of stores you're opening, right? 170 to 200 is a very solid increase on the 381 base that you had at the end of FY26. You will require around 1.2 odd crore per store. So on that, you'll require around 200 to 250 crore in terms of just pure store opening costs. and those have also gone up because of inflation, right? How do you fund it? Give us a sense of that first off.
So this year we plan to open around 180 to 200 stores, and we are on track to open that. And to open about 200 stores, you need approximately 500 crores. And I think just the EBITDA that we generate this year, plus we have given about 200 crores of prepayments to our vendors. So those are bill discounting facility that we give to our vendors, where they can get the payment of any bill with a bill discounting that they get. So I think whenever we need to invest that in new capex, we just stop that bill discounting, and 200 crores of cash can be freed up in the balance sheet. And you already mentioned it in your show before. The debt to equity ratio is still very favorable. So I think we still have the potential to increase the debt to about 350 to 400 crores.
Okay, but Akash, you've always been averse to debt. Whenever I've spoken to you, you've at least till at least a year ago, you were averse to debt. You said want to wait and watch. We don't want to play with debt too much. Does that stance change meaningfully, or is this just a lever that you're using temporarily to front end the growth that you're doing?
So the debt is only to service and to be the best paymaster to our vendors. It's to only have that facility of bill discounting. It's only for the working capital needs to pay our vendors earlier, so that we can help them with working capital, because in India still capital access to MSMEs is a challenge. And as our volumes are increasing, we want to help our vendors to have some working capital, to have increase their infrastructure, increase their capacity, and help us better in the future as partners.
Then that's not optimization for you from a cash flow standpoint. It's to help them out. Uh, uh, Cash flow optimization for you, how does that play out? If you can give us that perspective.
So we get a delta because the vendors give us a bill discounting percentage of about 18 to 24%, which is much higher than our cost of debt. So that delta goes directly in our gross margins. And in terms of our cash flows, I already mentioned, like, just last year we did an EBITDA, pre-Ind AS EBITDA of around 270 odd crores. So if you take a 50% growth on that, so we will be generating enough cash to be growing and opening about 150 to 180 stores.
Understood. I need to take a pause on this conversation, Akash, take a bit of a breather. I'll come straight back to you. By the way, viewers, if you're wondering how that 500 crore number is coming, so 200 to 250 crore is the quantum of capex which will be required to open the 180 to 200 stores. On top of that, you will require another 250 crore for inventory. And that's how you arrive at that 500 crore number in terms of working capital requirement for opening 180 to 200 stores. That's how it's set up. We'll slip into a break, come back, continue this conversation with Akash. Stay with us. Welcome back, and we're in conversation with Akash Agarwal, who is of V2 Retail. Akash, I'm just going to quickly come to you with regard to free cash flow, rather operating cash flow, not free cash flow. When does that turn positive for you? Just given the kind of clip you're going on, it's understandable that it's negative. When does it get positive?
So I think the long-term target is 2,500 V2 stores all over the country. And if our model keeps delivering the numbers that we've been delivering and the momentum continues, then we want to continue this 50% growth trajectory. So I don't think, if the business is doing well, the EBITDA and profit numbers are sustaining, and we are still delivering a good ROE and ROCE, then you would be seeing a positive cash flow, because we'll be reinvesting everything into the business to get that growth number and to be in as many districts as possible.
At what point do you dilute equity capital again? FY27, you've said mostly not required, debt plus, and it should, right? I mean, your debt is 250 crore, and therefore that should more than fund the incremental capex requirement. But then is FY28 the year where you again dilute equity?
So that is completely dependent on the number of stores that we want to open next year. If we again want to open 150 to 200 stores next year, then our internal accruals will be sufficient. But again, if this is a very strong year and we see all the new stores are doing well and the old stores get a very strong SSSG, then we might increase the store opening guidance for next year to 250 to 300 stores. In that case, there would be additional funds required, but again, it will completely depend on that market conditions in that particular period of time, and then we'll take the decision.
500 to 550 is your store break even? Is that the right number that I'm working with?
Yes, so store level cost is about for 140 to 145 rupees per square feet, and 500 rupees is the break even per square feet sale per month.
Okay, so 500 is that number. Now I'm trying to get to the point that is there any risk? Can you flag this off, right? You said that there could be demand risks just given the way in which inflation is hitting the economy as a whole and your cohort of customers in particular. What's the risk of your monthly average sale price per square foot going down? How likely is that? Because currently your mature stores are doing 1100 to 1200 and growing over there, and your newer stores are doing 700 to 750. Is there a chance that this could come off on a sales per square foot per month basis?
So if you take company blended, we're still at around 950 rupees per square feet of sale. So we have a huge margin of error, I would say, because 500 is the break-even point. And talking about overall macros, I think our price segment is counter-cyclical because see, when there's a demand pressure, when there's disposable income pressure, so a lot of people who are buying a higher ASP product move down to us. So that is why we have seen historically macroeconomic events or activities, except COVID, of course, when all the stores were shut, doesn't have a huge significant impact. There's a delta of plus minus 5% in terms of per square feet sale. So we still have a ample margin to play with.
What's the per square feet trend, especially with regard, rather than per square feet we have a sense. SSSG, what's the trend on the mature cohort, which is 3-4-year-old stores versus say year and a half year old stores? What's the SSSG there like?
So last year our SSSG was around 9%. So for mature stores, that was about 7.5%. And for the newer stores, it was around 10.5, 11%.
And you define mature being 3-year plus, 2-year plus?
So mature, we define as the stores that we had at the end of FY24. The
At the end of
111
FY24.
stores.
So less than 2
More than
years.
2 years old.
So less than 2 years plus, basically. That's
Yes.
the mature cohort. Okay, understood. And with regard to the 750 rupees per square foot, which is the brand new stores which you open, that's broadly what the per square foot revenue is. How quickly does it ramp up? If you can give us a sense from 700, 750, what's year two looking like? How quickly does it go up?
So I think the next 2 years we're going to find that out, because if you see the history from 2020 till 2024, we did not expand much. And FY25 was actually the first big year of expansion. So those stores, it's the first time this year that those stores have been a part of the SSSG calculations. So I think I would be able to comment better on that by the end of this financial year. But looking at the data pre-2020, we've seen that it takes about 3 to 4 years for a new store to mature and reach old store per square feet levels.
Akash, you as well as the family have done this really well in terms of building this up. And y'all have been in this for a while now. It's been now, I mean, the third decade in which y'all are playing this. Give us a sense, what is the risk to this story at this point in time? Is it competition? Is it customers not coming back because your customer return ratios are also quite high in that sense? Same customers keep coming back. What's the risk like? What are the metrics we look for?
So, see, in terms of opportunity, in terms of the growth story of India, in terms of the demand for value fashion in tier 2, tier 3, tier 4, I think it's all very positive. The only thing that can go wrong is poor execution. And again, if we lose our focus, or if we try to do too many different things or experiment with too many different things, that's why we have focused on this one model We don't want to premiumize. We don't want to come up with newer models. And we just want to focus on this model and get to 2,500 V2 stores in this country.
By when? By when do you get to 2,500?
See, again, that time frame completely depends on our performance because you've seen the
Right.
last 3 years, we've been increasing our store opening guidance. And that is because on the back of strong performance. So if we keep performing well, I can tell you that we will be guiding for very aggressive growth.
Okay, very aggressive. That's already the case, 50%. Akash, thank you so much for coming in and speaking to us.
Thank you for having me.
All right, that's the management of V2 Retail. Very confident, very comfortable. Of course, a couple of those parameters you want to keep in mind. I hope this show has given you enough food for thought. Completely timed out. Stay with us, more action on the other side.